All right, let's talk IPOs, initial public offerings. It's this whole world of insane hype, a ton of hope, and yeah, let's be real, sometimes a lot of heartbreak. So the big question is, how do you slice through all that noise? Well, that's what we're going to do today. We're going to build a super simple framework so you can analyze any IPO like an absolute pro. Okay, let's just jump right in. This slide, it pretty much sums up the whole IPO roller coaster, doesn't it? On one hand, you've got the Nazara Tech IPO. I mean, this thing sparked total euphoria, got subscribed more than 175 times. But then, on the other hand, you have the big, flashy Paytm IPO, which, well, it led to a huge price crash and left a lot of investors holding the bag. We're talking two massive tech IPOs with two completely different endings. And that right there, that's the multi-billion-dollar question, isn't it? How can one company make people rich overnight while another one just tanks? The secret, the real key, is knowing what to spot before you even think about investing. And guess what? That's exactly what we're about to break down for you. All right, first things first. We got to tackle the big monster in the room, IPO hype. We're going to pull back the curtain on all that frenzy and see what's really going on, and if any of that excitement is even real. Just look at the Nazara Tech frenzy. It's a textbook case. The things driving this weren't, boring old fundamentals. No, it was all about a powerful story. You had this first-of-its-kind gaming company narrative, a small number of shares making it feel exclusive, and a huge celebrity investor on board. I mean, that is the perfect storm for FOMO, the fear of missing out. The demand wasn't about profits or cash flow, it was pure emotion. Everyone just wanted a piece of the action. And this is where we get to some really crucial lessons. You see that massive oversubscription number? That's just an emotion meter. It is not a valuation metric. And that big price jump on day one, think of it like a firework. It's bright and exciting for a second, but it tells you nothing about the company's long-term health. So here's the real takeaway, the most important part. You've got to look at an IPO as a business you're investing in for the long haul, not just some one-day lottery ticket. Okay, so that brings us to step one of doing this right. You have to push all the hype aside and ask a really basic question. What does this company actually do? And how in the world does it make money? Zomato's a fantastic example here. You might think, oh, it's a food delivery app, but it's so much more. It's a whole ecosystem. You've got the delivery, sure, but also dining out services, B2B supplies for restaurants, and their pro subscription. They call this a flywheel, and it's a cool idea. Each part feeds the next. More customers means more restaurants sign up, which makes the service better for customers, which brings in even more customers, and the whole thing just spins faster and faster. And when you dig into the numbers, you can really see this flywheel in action. This chart, it shows the growth in what's called gross order value, which is just a fancy way of saying the total value of all the orders people placed. Now look at this. The whole industry grew, which is great. But Zomato, their growth was almost double the industry average. That's not hype. That's a clear sign their strategy is working. And they're just eating up market share. That's a real strength you can point to. This leads us to one of the most important ideas in investing, the competitive moat. Seriously, think of a castle. The business is the castle, and the moat is that big ditch of water around it that keeps enemies out. It's that special something, that unique advantage that protects a company's profits and market share from all the competitors trying to attack it. And Map My India is a perfect example of a company with a massive moat. Their advantage isn't just some clever piece of software. No, their moat was dug over 25 years, literally, by physically going out and mapping India street by street. Can you imagine? That creates a data advantage that is just insanely hard and expensive for anyone else to copy. Then you add in some regulatory protections and the fact that it's a huge pain for their big corporate clients to switch away, and what you get is a really, really wide moat. Okay, so we've got a handle on the business side. Now it's time to put on our detective hats. We're going to learn how to crack open that giant, super intimidating IPO document and hunt for the critical red flags. And this table? Think of this as your secret decoder ring. Seriously, you do not need to read all 500 pages of that document. Just focus here. For example, look at the capital structure section. Is a big chunk of the IPO something called an offer for sale? Whoa, red flag. That often means the insiders, the early investors, are cashing out. Or check out objects of the issue. Are they super vague, saying the money is just for general corporate purposes? That's another big red flag. It kind of screams, we don't have a solid plan for this money. And that brings us to our poster child for red flags, the Paytm IPO. Look, everyone knew the brand, it was super popular, so a lot of people got sucked in. But if you just scratch the surface, man, the warning lights were flashing everywhere, both in the business itself and in the structure of the IPO. Let's just tick them off, shall we? 1. The company was burning cash like crazy just to stay in business day to day. 2. A massive part of the IPO wasn't for the company. It was for insiders to sell their shares and get rich. 3. The valuation was sky high, assuming they dominate a crazy competitive market, which was a big assumption. And 4, this is a big one. Their marketing costs were growing just as fast as their revenue. That's a huge problem. It means they weren't actually getting more profitable as they got bigger. It was just a textbook example of what to watch out for. Okay, I really want to stop and focus on this for a second because it is so important. You have to understand the difference. A fresh issue means the money from the IPO goes to the company. For what? To build new factories, to hire people, to grow. But an offer for sale, an OFS, that money goes straight into the pockets of the founders and the early investors. So when you see a really good OFS, that's a potential red flag. It could mean the people who know the business inside and out are saying, all right, we're out of here. Now, the LIC IPO is a really interesting and different kind of example. This was a 100% offer for sale. Not a single rupee was going to LIC to help it grow. All of the money was going to the government because they were selling off a piece of their stake. So you have to understand the goal here wasn't about funding the company's future growth. It was about the government successfully selling its shares. And this quote just nails it. The whole thing was designed to not fail, not to re-rate. What does that mean? It means the main goal was just to get this sale done without any issues. It was not designed to see the stock price shoot up over time. The number one priority was making sure all the shares got sold. For anyone looking for long-term growth, well, the very purpose of this IPO was a structural red flag. All right, so we've spent a lot of time on the scary stuff, the red flags. But it's not all doom and gloom. You also need to know what to look for, the positive signs, the green flags. So, what does a strong, solid, trustworthy IPO actually look like? I love this slide because it just lays it all out, the two different universes. On one side, you have the speculative gamble, an unprofitable company, insiders running for the exits, and everyone talking about vague metrics like user growth. And on the other side, you have a stable foundation, a company that's already profitable, an IPO that's actually designed to fund more growth, and revenue you can actually understand. It's literally the difference between a house of cards and a brick fortress. SBI Cards is a perfect example of that fortress. First off, it was backed by the State Bank of India. I mean, you can't get much more credible than that. Second, it was already profitable from day one. This wasn't a bet on some far-off dream. And third, it was in a clearly regulated industry. These are the kinds of things that build real, lasting trust with all kinds of investors. And DMAR is another great one. Their business model was so simple you could write it on a napkin, everyday low cost. And they had the receipts to prove it worked. Years and years of financial data showing them growing and making money. See, this wasn't about buying into a story. This was about investing in a proven, well-oiled machine that was already crushing it. Okay, we have covered a ton of ground. We've talked hype, business models, red flags, green flags, the whole shebang. So let's boil it all down into a simple, powerful checklist that you can use for any IPO you ever look at. Here we go, your simple 3-step framework. Step 1, analyze the engine. Understand what the business actually does and what its competitive moat is. Can it protect itself? Step 2, hunt for red flags. Go through that document. Are insiders selling? Is the company just burning through cash? And step 3, look for the green flags. Is there a track record of profit? Is the money being used for growth? It's that simple. Engine, red flags, green flags. Remember that. Look, let's be real. The next huge, hyped-up IPO is right around the corner. It's going to be all over the news, the headlines will be screaming, and that FOMO is going to be intense. But the real question is, now that you have this framework, now that you have the tools, are you ready to see past all that noise and make a truly smart decision?